The US stock market is worth 2 times annual GDP. Why does this matter? Because this valuation is completely out of line with historical norms. In this video, we're going to look at how today's valuation stacks up to market history. Hey everyone, Brian here. I write EWI's monthly European financial forecast, and my US colleagues just published this chart. I've seen it before and it shocks me every time, honestly. What we're looking at here is the Wilshire 5000 divided by GDP. So it's the size of the stock market compared to the size of the economy. Same indicator Warren Buffett uses to measure value. I like it because it's simple and intuitive, right? It's rational. It's logical for stocks to grow alongside with the economy. The problem is, and the opportunity comes when you understand that investors are never rational, right? When people get too excited or too scared, stock valuations get completely out of whack. That is why we see points like July 1982. If you know financial history, you know that the stock market had gone nowhere over the previous 17 years. Treasuries were paying double digits back then. Investors wanted nothing to do with stocks, and so the market shrank to about 1/3 the size of the economy. That was completely out of whack. And so you fast forward to a time like March 2000. Stocks have been rising slowly at first, then faster. Everyone finally joins the party. At the height of the dot-com bubble, the market is suddenly worth 1.5 times the size of the economy. That was a crazy valuation at the time. And we now know what happened, right? Everything goes bust. Stock valuations shrink to half of GDP by March 2009. This pattern repeats. It's endless. Here we are today with stocks now twice the size of the economy. So what does this tell us? At minimum, I think it says to be very careful investing in this environment. The long-term average is below 90%, and Warren Buffett has said he uses 120% as a sign the market is overvalued. Does this mean stocks are going to crash tomorrow? No, this is not a near-term timing tool, but could we see a period where stocks go nowhere for 10 years, 20 years? Absolutely. Could there also be massive drawdowns? Definitely. If you jumped into stocks in the late 1990s, you weren't really getting back to making money until around 2014. That's a big chunk of the average investor's time horizon. We could very easily see something similar again. So that is my take on graphs like this. Let me know what you think. I'm going to do more videos on this subject because investing over the coming decade or longer will be much, much different than this past decade. So like and subscribe if you want to stay on top of these trends. And if you're serious about navigating these markets, the links in the description will take you to our full services. Thanks for watching. See you in the next video.